All right, welcome back to the show. Money Grows on Trees podcast. My name's Lloyd Ross. This episode is titled, Why Did the Stock Market Fall This Week? Stock Market Correction 2024. That happened just this week, over the last week, I would say, since Warren Buffett started selling his Apple position last Friday. So he liquidated about $50 billion, maybe it was 75, half his Apple position, might have been more than that, 80 or 90 billion. And it was his largest position. So Berkshire Hathaway, which is the company that he didn't actually create Berkshire, he built and developed Berkshire Hathaway. It was actually a company that he bought many years ago, 1965, I think. And he's built all these other businesses under that umbrella, and it's now worth $900 billion. And so Warren Buffett has liquidated some of his Apple position, which is a big deal because it was a huge position in his portfolio. And in fact, it made up 50% of his portfolio. And of course, that kind of set off maybe the beginning triggers of the correction. But the real reason why it happened is because of the reverse carry trade out of Japan. And what that means is people in Japan has had 0% interest rates for many years, meaning you can actually borrow money in Japan for 0%. Incredible, right? Free money, basically. And what happened in Japan recently was they increased their interest rate in the country for the first time. And that actually wobbled a few people because up until this point, you could borrow money in Japan for 0% interest and then deploy it into buying stocks in America, American tech companies. And a lot of the funds going into the American tech space have come from borrowed money from Japan. And so now when rates go up in Japan, people are like, I need to pay the money back. I don't want to pay the interest on that money. So they're selling their positions on the New York Stock Exchange or the NASDAQ, wherever they've got money invested, and then they want to pay their loan back in Japan. And so that's what's happened. It's called the reverse carry trade, and that's what's caused a lot of the selling to happen in the United States, in New York Stock Exchange or the NASDAQ. And so the market corrected by 10%. But here's the thing. It happens every 18 months. The stock market will correct by 10%. It's nothing new. It will continue to happen. But people freak out, and the news starts to freak people out with it because they start to say all these things and justify it. People say, well, Warren Buffett knows something I know. Well, if you learn about Warren Buffett, you know he doesn't time the market. So actually, he's not timing the market. What he's doing is rebalancing his portfolio. Because for a very big portfolio now, if you look at Berkshire Hathaway as a company, $900 billion company, about $280 billion is now in treasury bonds. It's cash, effectively. Treasury bonds aren't cash. They're actually an IOU from the government. So when you buy a treasury bond, you are actually lending money to the government. Now, what's fascinating about that is Warren Buffett now has more treasury bonds than the Federal Reserve. In fact, Warren Buffett owns more treasury bonds than France. Okay? So, yeah, it's a lot. Japan has the most. Japan has about 1.1 trillion treasury bonds, and then followed by China has a lot. But Warren Buffett, 280 billion, that's pretty good. And so people often think that is like a signal to the market that he's short equities. But, he still owns, that's only part of Berkshire Hathaway's market cap. The rest of it, the other 600 odd billion, is actually spread across his portfolio of stocks, which would be I think it must be around about 250 odd billion, 200 billion. I'm not sure. I haven't done the numbers today since he liquidated some of that Apple position, but also operating businesses. Berkshire Hathaway owns private businesses, like it owns BNSF Railroad. It owns Berkshire Energy. It's big private enterprises. And so it's made up of public companies and stocks, private businesses, and now cash. And it's not really cash. As I said, it's US Treasury bonds. So Warren Buffett is saying, hey, I'm actually going to build up a war chest of cash here, or Treasury bonds. Risk-free, they are, Treasury bonds. They're guaranteed by the US government to be paid back. So they give you about a 5% return. So he's actually getting a 5% return from that investment, just so you know. It's not like actual cash where it goes down in value from inflation. It's actually a financial instrument. He's actually lending money to the government, the bond. So anyway, he has that. So people are saying, well, Warren Buffett timed the market, it's going to crash. So all this news starts coming out, and then the reverse carry trade in Japan happens, and then it's like, well, this is what's causing the correction. But here's the thing, it will happen. It will continue to happen. You don't have to lose your mind when the market corrects. And your investment strategy should not be dictated by market movements. You should invest the same way with a market correction as you pretty much do when it's a steady market. And you should be doing much the same thing when the market's rising too. You should be doing much the same thing all the time if you know what you're doing. It's like trying to wait for a real estate correction to buy real estate. You just got to buy and then be patient. Time in the market beats timing the market every single time. And Warren Buffett's not a market timer. So if you study Warren, he will tell you he's not a market timer. How do I know that too? Because he says in 2007, when Berkshire Hathaway spent $10 billion and bought a ton of Wells Fargo stock, I think it was $10 billion. The next year, the GFC happened and all the banks went pretty well broke. So he's like, well, I didn't really time the market good there, did I? So he's not a market timer. He finds good quality assets that he likes, either businesses, private businesses, or pieces of public businesses, and he buys that. But right now, he likes treasury bonds. Okay, so he obviously sees that there's a benefit there to parking his money in a risk-free asset, getting 5% return. So that's great. It doesn't mean you have to freak out and lose your mind over this correction. So every 3 to 4 years, it will correct or drop by 20%, and every so often, occasionally, it will actually crash. So let me read out to you. I shared this in our Telegram group. If you're not following our Telegram, it's a free Telegram channel, lloydstelegram.com. Go in there and I'll share with what I posted in there. I was talking about the crashes yesterday. I put this post in there, right? It's in here. So this is the worst stock market crashes in history. Obviously, 1929, the Great Depression, which what kicked off the Great Depression, the stock market fell by 89%. So that's a lot. Top tick to bottom tick is a lot. So people thought the world was ending, and it effectively went into a depression, which kind of did end. But that's as bad as it gets. And then oil shock in 1973, which was what kicked off the inflationary pressures that took interest rates to 20%. You know, you'll hear your parents say, hey, we had 20% interest rates. That's because of the oil embargo. There was an issue with the supply of oil. And then all of a sudden, the oil price went up. And oil's in everything. Oil's in everything. It's everything has got oil in it. So, of course, the prices went way up. And so interest rates went way up. And that caused the stock market decline of 48%. Then Black Monday, 1987, where all the stockbrokers are jumping off buildings, right? It's a flash crash. The stock market fell top tick to bottom tick 34%. And then dot-com bubble. So when companies were selling for there was no earnings in the company, they were just like, we're launching a company, it's online, I'm going to buy it. It's like a bit like Bitcoin. The market fell by 50% or 49%. That was in the year 2000. The global financial crisis, which was I lived through, and that's what really got me interested in investing, it fell 56%. That's the second biggest ever. It was huge. So Warren Buffett bought Wells Fargo Bank right before that. So again, I'm telling you, he's not the best timer, and he knows that. So, and then the COVID pandemic, where we put a couple big great positions in the COVID pandemic. One of them's almost doubled in size, which is great. So it's 20% compound return. And that was fun. I mean, not fun, but it was fun to, it was a very beneficial crash to go through because you could see very clearly that it was going to actually not be around forever. So it was caused by something that was just pure panic. If you did enough research, you realize that coronavirus wasn't killing, it just wasn't doing what the press was saying it was doing. So it was easy to see that the world would recover quite quickly from this. So it was quite simple to deploy capital. Whereas the global financial crisis was very difficult because banks were actually going broke. So that was a big systemic problem. So that was very scary, and that was very hard to know what to do. And that's when Warren Buffett ended up buying a lot of Bank of America. He lent them $5 billion. They called him up and said, Warren, we need money. So anyway, my point is that you don't need to worry about this because your investment strategy should not be dictated by market movements. You shouldn't be trying to time the market. You know, someone even said to me, Lloyd, I know I shouldn't be timing the market, but, as one of my students, I'm like, well, people are always looking for advice during these times. And one thing I'd encourage you to do is not be someone who depends on advice. Because if you give your money to someone to manage, or you depend on someone's advice, steer the wrong way, and all of a sudden you're not in control. I did that once when I was in my 20s, and I spoke to a guy, an advisor, and when I was living in Dubai. You know, he put me into this thing, and back then there was front-end loaded funds, all this weird stuff, and it didn't turn out so well, and that's what prompted me to get into financial education, educate myself financially, so I didn't have to depend on anyone else but myself. And so that's why when there's, various things in the market, there's a real estate crash, or there's a stock market crash, or there's this new thing called Bitcoin, or there's this or that, I know how to navigate that because I've actually done the work to educate myself around what assets are, what businesses are, how that works, and I'm involved in it. And it's a lifelong journey, but I think I've been on that journey since 2009, so I would say 15 years. And so I would encourage you to educate yourself. If you look at market history, you can see that market corrections 10% are always going to happen. It doesn't mean the world's ending. And if you understand investing principles and you've done it, heard any of me talk, obviously listen to the show, I think most people should just be indexing if they want to invest or buying real estate and keeping things simple. Simple scales, complex fails. And it's just not that difficult. And I think people try and make it difficult. But if you just index, as an example, you would outperform 90% of professional money managers. And what a great outcome that is for you. Not much effort at all. But people can't seem to grasp that. They want to find something that's more complex and more, it's going to grow. I think just keep things simple. Don't worry about the market movements. You should be buying consistently all the time if you believe that the world's going to get better. And if you have kids, then you automatically believe it's going to get better. Because if you didn't think the world was going to get better, you wouldn't have kids, right? So I think the world's just going to get better and better and better. In which case, businesses are going to do better. The economy is going to do well over the long period of time. Over the next year, no one knows what it's going to do. No one knows what the market's going to do over the next, couple of years. But in the next 5 to 10 years, businesses are going to be earning more, growing more, solving better problems more efficiently. AI will enhance all those businesses, of course. And, that's what you want to bet on. You want to bet on the growth of the economy and the human race on Earth. Because even if you bet on the end of the world, even if you are right, you don't make any money. Don't worry about these gyrations. If you look at the history of markets, they're very normal and they will continue to happen, and it shouldn't worry you. You should never really lose any sleep when it comes to investing. In fact, if you're losing sleep, you're probably not doing it the wrong way. And if you don't understand that, or that's not happening for you, then I'd encourage you to educate yourself. I'll explain to you why the market corrected effectively. Then it happens a lot. We went through some data. It's going to happen, keep happening. and you can outperform 90% of money managers. In fact, I'll go one step further and say this. Warren Buffett, over maybe 4 or 5 or 6 Berkshire Hathaway annual meetings, has explicitly said in these words, most of you should just buy a simple index fund. Now, I'm not suggesting you go do that, but that's what he said. And he went even further, and in his will to his wife, Astrid, it says, when I pass away, I want you to take this money that I'm giving you, and I would like you to invest it into the S&P 500 index fund. So good enough for his wife, good enough for him, good enough for... He even said in a meeting, he said, if I was just a layman investor, I'd buy the index in a heartbeat. I mean, how many clues do you need before you just take that on board? And this is so simple and so effective. It's too simple. And it's one of the things where you don't actually work harder to get better. You work less and get better. It's fascinating. A bit of a paradigm shift you have to make when it comes to investing correctly. And the same with real estate. You don't have to gear up. You just buy high quality, good location. Same with the stocks. You just buy high quality, good quality businesses and a group of businesses like an index. And you add to that over time, and you look for unique ways to make extra cash flow, and you just put that to work. And that's just the repeating process you do. You just try and stay out of debt. This is it. This is the basics of wealth creation. And so I hope you've enjoyed this episode. If you have enjoyed this episode, then please click the button and share it, and leave us a 5-star review. That'd be amazing. We have over 135-star reviews now on the show, which is great. And we started a video podcast because this is video now. So go ahead to the YouTube channel, click the subscribe button, leave us a comment. I'll come and engage with you. Leave us a comment on Spotify, and go check out the show notes. So I'll put the show notes in here. Go grab my latest book, Money Buys Happiness. You'll see the 5-step framework that I'd encourage people to do to get their money under control. Go join the Telegram channel, lloydstelegram.com, because in there I do share daily money tips. And of course, thanks for those who have left a review and shared and engaged. And I look forward to speaking with you on the next episode of the Money Grows on Trees podcast.